If you're about to buy a home or your mortgage is coming up for renewal, there's a moment when your entire outcome is decided. And most people don't even know it's happening. Most people think they mess up at the end when they decide the rate. But I used to sit on the other side of the desk. That's not what happens. It happens in the first few moments of the conversation. And once it happens, it's almost impossible to undo. So in this video, I'm going to show you the exact moment where you lose control of your mortgage and what to say instead that you remain in control the whole time. Most people just think that they're answering questions, but they're actually setting the direction. And once that direction is set, everything starts to follow it. And here's the problem. By the time most people actually notice it, it's too late to change. But here's what's interesting. Even though you understand what is happening, most people still walk into the next step the same way. They sit down and they let the conversation lead them. And that's where things quietly go off the track. So instead of giving you more information, let me show you how to actually control this conversation while it happens, what to listen for, and where most people lose control of the outcome. Again, this isn't just about getting a mortgage. It's about controlling the process of who decides it. So let's start at the moment that everyone gets wrong. When the conversation starts, most people go to, what am I pre-approved for? And that sounds like the right question. But the moment that that question is answered, that number becomes your reference point. Everything starts to revolve around what you look at, what you feel comfortable spending, what starts to feel normal. And that's what I call the approval anchor. And once that anchor is set, everything after that quietly pulls towards it. And this is what most people don't realize. That number, it just reset your expectations. And the bank, it's not asking what's comfortable for you. They're telling you what you're approved for. And that approval is not based on your life. It's based on a formula. I've seen it so many times that a couple was comfortable spending about $600,000. Then they get pre-approved for $750,000. And without realizing it, they start adjusting their life to fit the approval, not the other way around. And that's where people accidentally take on more than they wanted to without making a real conscious decision to actually do it. But nothing in this changes their budget. Only that number changed. And that one number quietly increases the pressure for the next 25 to 30 years. So instead, what should you do? Well, slow down. And the first thing you say is, before we talk about the approval, here's the budget that we're actually comfortable with. Now the conversation changes because that number is based on how you actually live. And if those two numbers, they don't match, it's your budget, your number that actually matters. Once this is done, the conversation often then moves into down payment. And honestly, it's usually as quick as this. Hey, based off of your approval amount, this is how much you need for a down payment. And that's where most people stop. They hear that number, they know it's in the account, and they assume that they're ready. But that's not the real number. The down payment is just the beginning. The real question that you want to ask is, how much money do you need left over after all of the closing costs? Because it's not just the down payment. You pay 1.5% approximately for closing costs. There's moving costs. If there's repairs that need to be done on the house. And then you also want to have a $5,000 to $10,000 buffer because things happen. And all that money, it all comes from the same place. People think that putting all of their money into their house is the smart thing to do. But what most people actually do is they drain their buffer. And that's where things can feel tight. And I've seen this happen a lot. Someone builds their budget thinking that everything is going to stay the same. And everything feels fine on paper. Then a few weeks after the house closes, a new expense pops up. Whether it's car repair, or the water heater needs to be replaced, or there's an issue with the roof. Now they're adding payments to a budget that they've already maxed out. And that's when a comfortable mortgage starts to feel stressful. So the real question is, can we buy this and can I have enough money for the down payment? Instead is, what does this leave us with after everything closes? Because that number will determine how comfortable you are after you move in. The next part of the conversation usually goes into term, and they'll say something like this. You know what? Most people just take the 5-year term. And this is true only because everybody follows the same advice and just agrees to take a 5-year term. But this is where I want you to step back, because this decision is not about today. It's about what might change. So here's the question that you ask yourself. What in my life could realistically change over the next 5 years? Not just what you expect to change or what is for sure going to change, but what could possibly change. So think about it like this. What would you say yes to? Something like a better job, a move that makes sense, a nicer home, an opportunity that you currently haven't planned for, but you'd accept if it was offered to you. These are definite plans, but they are possibilities. And this is where most people go wrong. They just blindly choose the 5-year fixed rate based on what they think will happen instead of what could happen. And I'm not saying that the 5-year fixed rate is not a good choice for a lot of people. It's just important to actually look into your situation to make sure you're making that choice for you. And think about it like this. A bunch of very small chances can add up to a very likely chance that you have to break your mortgage during your car. And mortgages don't just adjust to your life changes. You break them. And when you break them, you pay for that change. And most people assume that people break their mortgage because something went wrong. But often they break it because something good happened. A new opportunity, a better move, an upgrade that they didn't expect. And now they're paying a penalty for moving their life forward. So instead of asking, what term is most common? You ask, what term actually fits with my life? And the goal is not to predict perfectly. It's just not to be trapped if something changes. And then you get to this part. This part, everything feels simple again. You start seeing options, rates, terms, different lenders. And it finally feels like you're comparing them properly. And most people, they look for one thing. What rate is the cheapest? And I want to be clear, lower rates are important. And rates are good to look at because it looks like the simple comparison. But that's where it's misleading. Because what you're looking at, it's not just a rate. It's a set of rules disguised as a rate. And two mortgages can have the same rate and look identical until something changes. Then they behave completely different. And this is where the cheapest mortgage can be the most expensive option. So instead of just comparing numbers, you should ask different questions. What happens if I need to break early? Does this bank use posted rates for penalties? Does this lender have the ability to port? Does it have a line of credit? And this is where most people get caught. They choose the option that looks cheapest today without realizing how it behaves later. And that difference is where most of the cost shows up. Not in the rate, when your life doesn't go exactly how you plan. And this last part is where nobody actually pays attention. It's about the person who you're talking to, not just what they're saying, but what they tend to recommend, how they're paid, and what lenders they have access to. Because that shapes what you see. And most of the time you don't notice it because it feels like guidance, but it's actually filtered. And this isn't about good and bad advice. It's about understanding that every recommendation comes from a point of view. And that point of view is influenced by what they're familiar with, what they trust, and what they're incentivized to recommend. So two people can look at the same situation and recommend two completely different things. Not because one's right and one's wrong, but because they see it differently. So instead of just accepting what's being shown, you step back for a second and ask, if I talk to someone else, will I get the same answer? Because that answer tells you how much of this information is universal and how much is perspective. And their perspective is influencing your outcome, whether you realize it or not. So now you're not walking into this conversation blind. You're directing the conversation. And that's the shift, because most people go into a conversation and they're being guided. Now you're the one who's setting the direction.